Chat, hello. Thank you for being here. You're in for a treat. We have Bitcoin Schmitcoin here, and he's going to have a nice discussion here in a minute. Schmitty has taken the floor, and live.
Okay, so I don't know the depth of everyone's understanding of like market cycles and stuff, but the general idea from like a 30,000 foot overview is that there are periods of accumulation, there's a markup period, typically there's a reaccumulation period, and this kind of goes on and on until the market hits this critical point where the amount of free floating supply equals the amount of demand that is driving the market. And those are typically locations where trading ranges form. Prior tops in the crypto market that everyone's probably familiar with look a lot like this, right? We see this big blow off top. Everyone's getting girlfriends. Their girlfriends are getting girlfriends. Everyone's really excited. People I joke about this, but it's actually a very good top indicator. People start saying they're quitting their careers to quote unquote here it is, do crypto full time. That's your top indicator. When people start saying they're going to do not trade crypto, they're going to do crypto full time. Okay.
So true.
What that means is they probably bought around here or here. Usually not the people that got real heavy here. If they were, then they probably started doubling down here, tripled down here, and it moved their average entry really, really high. So what ends up happening is we have these we call them parabolic blow-offs or hypodermic blow-offs, and we see this really strong deviation from the trend. This has happened across many markets, from gold to stock indices to tech indices to tech stocks. Tech stocks had a really famous one that happened, in the 2000s, but they kind of generally follow the same flavor. So we'll have this upper boundary, and then shit just goes really crazy, and we see this. This is the parabolic blow off, sometimes referred to, if you're a Wyckofian of sorts, as a hypodermic blow off, because it looks like a hypodermic needle breaking through the upper boundary of the trend. And keep in mind that this is a log chart. So if we take off the logarithmic scale, it looks even more crazy. Like, it looks just absolutely insane, where you just see this this rise, and it's just it's totally unsustainable, and it breaks, tries to regain in the trend, and it fails. That's not what we're seeing right now. What I believe is most likely the case, it remains to be seen, because we're going day by day here and seeing what the market gives us. But what I believe is taking place is something that's more along the lines of something like this, where you're probably thinking to yourself, well, this looks nothing like this. Like, look how big this is, and look how small this is. Well, at the time, if you were here back in 2017, this was really big. In fact, let's just look at the magnitude of this thing. So top to bottom, it's covered 41.5%. I'm sure on more illiquid exchanges than Coinbase, it probably covered something like 40 to 50. But it's the same general idea that you see this massive amount of free floating supply into the market, and it's just totally unsustainable. We see this this breakdown, and we see something that looks like this at the time, right? So imagine we're here, like, oh my God, the world's ending. Where is support? There's no support here, right? There's nothing all the way down. Oh, that's a terrible line. There's nothing all the way down until 12:55. This in the moment, I remember, because I was living this moment, this felt exactly like how it feels right now. We see a strong bounce, right? Again, breaking support. Where's next support? Well, it's way down here. Everyone's thinking doom and gloom. The market's over. And funny enough, at this point in time, there was a huge amount of bloat in the altcoin market, and it just became unsustainable. Well, if we fast forward this a little bit, right? So we see this lazy bounce, and it looks like a dead cat bounce, and you're like, okay, cool. It rallied up to resistance. It's getting turned down, and the same sort of thing continues to happen, right? Like if you're living this, you're thinking, oh man, this is a bull trap. This looks like a textbook bull trap. It can't regain the support, and it just keeps slamming into this resistance, and it's unable to reclaim the support. Well, sometimes in specific situations, the market doesn't always have to parabolically blow off, but sometimes it will form a distribution range in lieu of a parabolic blow off. A distribution range does not always mean a bear market is coming. Sometimes, and we have a lot of examples of this in not just crypto markets, but markets with a lot more history in them, like in the stock market and metals and stuff. A distribution range forms, and there's a strong enough move to the downside that it shakes enough of the free floating capital, the over leveraged traders, the quote unquote weak hands. Maybe you're late retail and you bought in here, and this breaks support, you freak out and you sell. All of those sorts of people get shaken out in these really, really aggressive moves to the downside. Now, that doesn't mean that every trading range that forms and has an aggressive move to the downside is going to form this V bottom. That's not what I'm saying. But what I am saying is that there is a tendency to think that market tops all behave the same and they all have the same reaction. And that's just not the case. So with trading ranges, there's a way to actually count or to calculate the downside objective. So if you're relatively new to trading, like maybe you're familiar more with like a bull flag, right? Or maybe even like you see a triangle formation where the price is bound within the triangle. You know within a modest degree of certainty that when it breaks to the upside, it has a measured move, and you can calculate it, right? Well, trading ranges, much like we have here, they have a similar sort of methodology behind them. It's a lot more complicated and it's a lot more nuanced, but it is the same sort of idea where if you look at the anatomy of a trading range and you look at the swing lows, the swing highs, the breaches of the lows, these all get put into what is known as a point figure chart. The downside objective can be calculated using the anatomy of the trading range. The people who traditionally use point and figure charts are like the old school guys. Like you've probably seen the guy Bruce Frazier. He's like one of the really renowned Wyckoff experts, and he uses point and figure charts. There are a couple other old school guys that use point and figure charts, but the downside objective using this trading range is between 26,000 and 31,000, where the 31,000 is like the most conservative estimate, and 26,000 is the most liberal estimate. We can clearly see we broke the 31,000. We even retested it really cleanly, mind you, like almost to the dollar, 31.60 ish, like right in here. With that in mind, there's a really good argument to be made that the market has actually bottomed here. And what we're seeing, and although it feels like the world is ending, and maybe your portfolio is down a lot, and you over leveraged yourself and you're just eating plates of shit, right? There's a really good argument to be made that this move is actually something more along the lines of something like this or something like this. And at this point, you're probably tempted to say, well, I mean, this is considerably different. This is a 41% move. This was a 40% move. This move is way stronger. This is totally different, right? Look at the peak to the low. We see something much more concerning, and it's a 54% move, something greater than 40, right? Significantly greater than 40. But again, it comes down to the trading range that birthed the downtrend. When we compare the trading ranges, this one was significantly larger. So I'll go back to the daily view here. So the trading range here is significantly larger. You can argue the beginning of the trading range was here and the end was here. So it was 94 days long. If we go back to these, you can see quite clearly, like they're much smaller. Something like this, which was only 37 days. Something like this was only 30, 31 days. And so the magnitude of the reaction to the market is directly proportional to the size of the trading range. Much like if we were to draw a bull flag or a symmetrical triangle, the bigger the triangle, well, the bigger the target. So the same sort of rationale can be applied to trading ranges. And I know this probably seems like bullshit at this point because you're probably thinking, this guy, if you follow me on Twitter, this guy was super bearish. Jack was super bearish, blah, blah, blah. Now they're just offsides. What ends up happening a lot of the time here is a really, aside from like the sentiment, the quote unquote sentiment gauges where it's like, oh, everyone on CT is shorting or they're longing or whatever. That's never a really good metric. But what is a good metric is open interest on margin positions and funding rates alongside the relative market conditions of the altcoin markets. When I say altcoin markets, I mean altcoins as a whole. The way that I view the market personally, and the way that I try to teach other people to view the market, is I view it as literally just two things. You have Bitcoin and you have alts, and that's it. Within alts, of course, you have like sub alts that are more or less volatile.
Right.
But the risk buckets are Bitcoin and alts. And this has proven to be the case throughout the past few years, where you have different market cycles. Even if it's a couple month market cycle, like what we saw back in 2020 or 2019, there's a steady flow of capital that goes from USD, and then goes into Bitcoin. Bitcoin goes into alts. Alts go into riskier alts. If it's a really strong market, they'll go into riskier alts, like really low cap alts, and you start seeing shit like Dogecoin going crazy, right? But at the end of the day, this whole cycle starts like this and works its way backwards. And the reason for that is it's really simple. It's a matter of liquidity. If you are a big guy, a big player, in the Wyckoff theory, we would call that person a composite operator. And the composite operator is just, it's a literary device to try to understand the quote unquote whales. And rather than looking at them as individuals, you look at them as like the net effect of them. You call the composite operator. So if you look at like the net effect of like, if you look, for example, at like the trend of wallets, like I've seen on Jack's stream, he's talked about the Glassnode chart, right? When we see wallets trending down. That is a visual representation of the quote unquote composite operator. And the composite operator in Wyckoff theory is there's a constant battle for liquidity. Because if you have a bunch of money that you want to invest in the market, you don't just buy it up at once. You form trading ranges. And if you have a bunch of money that you want to get out of the market, you have to do the same thing. You have to make trading ranges. And the whole point of the trading range is you're fighting liquidity. You don't want to slip the market by just market buying everything, and you don't want to crash the market by market selling everything. And so when you see these rotations where you see USD to Bitcoin, Bitcoin to alts, alts to riskier alts, it comes back the exact same way that it started, where USD is the final result, right? Because Bitcoin USD, and that's game over.
I like that. I haven't looked at it that way. I like that.
Yeah, so the same way that they enter the market, they have to exit, because this is of course the lowest liquidity, second lowest, alts being like your Litecoins, your Link, your Ether, whatever the top 10 altcoin du jour is, and of course there's always Bitcoin, which is the most liquid, and then USD, of course, and that's not to say that like they ever completely exit the market. Because there are whales that just hang on to a large portion of Bitcoin. It makes sense, but that's the profit-taking rotation that takes place. And something very unique that happens in bull markets is what we saw on Sunday morning, and that's what leads me to believe that we are more likely to be here and less likely to be here. and that was altcoins capitulated while Bitcoin did not. If we look at this trend of drops, right? We saw these sorts of bounces, and we saw this massive liquidation event. I think I forget the actual number, but it was something like 800,000 crypto traders were liquidated on this move. It was something insane. Like, it was one of the biggest liquidation events that has ever taken place in crypto.
Right.
Well, Sunday morning, everyone was shitting their pants. They're thinking, "Oh my God, this is round 2, right?" Well, it was only round 2 for altcoins. If you go to all your favorite altcoins, whatever it was, they all puked a new low, like really low in some cases. Like, we saw Link go down to single digits on some exchanges, if I remember correctly. But what we didn't see is Bitcoin doing that. And so what that is a telltale sign is that is a telltale sign of capital rotation and selling absorption. And so selling absorption, what that means is that in this sell-off event, there are signs that the buyers are still interested in the market, and they were just rotating their capital. Okay. When we look back through history, to be honest with you, I really don't like referring to these sorts of things because I don't like small data sets where it's like, oh, it happened two or three times, so it's going to happen again. Like, that's a terrible reference. But the point stands. We saw the exact same thing happen here and here, where, well, more so here, because this one didn't even have a retest. It just puked and then rallied. But we saw the exact same thing happen here with Ether, and all the other major altcoins. So if you were in 2017, you remember there was a massive sell-off event from the 4,200 figure. I'm sorry, $420 figure, because crypto's a meme, and it sold off to something like 130. It depends on the exchange you look at, but it was like something like $170. Some went down as low as like 130. But I think 170 was the bottom on Coinbase, something along. It doesn't matter. So we saw this huge drawdown on Ether. What we saw was that Ether way overreacted, and all the other altcoins way overreacted on the drop. And at the time, I remember it felt like the world was ending. People I know got out of the crypto market. They sold the bottom. The market rallied without them, and they were permanently bearish for the rest of the entire bull market because they just couldn't cope with the situation, right? They got their mind fixated on one thing, and they didn't adapt. And what ended up happening was right here and right here, when the market recovered, the liquidity that left the altcoin market came back into the Bitcoin market, and Bitcoin continued to rally without the alts, and we saw this massive consolidation. So disregard this giant. This is just disregard this. This was a liquidation event that took place on one exchange. Okay, so we can see here that the crypto market bottomed at like 130, right? And so follow my my cursor here because it's going to track along with the price, right? We can see here that on these massive dumping events, the market seeks the most liquid avenue it can. Because at the end of the day, despite what you might think, if you have a lot of money, you don't give a shit if it's Ethereum, Dogecoin, or Cummies, okay? You want to be able to get in and out of the market and not lose your ass. That's the battle, okay? And so when we see these massive drawdown events like this, this is the market recovers differently. And what we see is that every time we see these massive downticks, this is the first opportunity for the whales, or the composite operator, quote unquote CO, to rotate. It's a rotation event. Not they use the capitulation liquidity to rotate. And they're constantly playing this game of hide the ball. Okay? Because what is the first thing everyone did on the drop? They went and bought their favorite altcoin. They went and bought their favorite altcoin because before the drop, altcoins were just destroying Bitcoin. Bitcoin dominance was plummeting, and they all went and bought their favorite altcoin. But what's most likely to happen next is that, yeah, they'll recover, right? There will be, if we are, this, keep in mind, this is assuming we are going to have a macro bullish continuation, right? This is the grand assumption here. So everything I'm saying is operating under this assumption. Assuming this is what's taking place, the most likely thing that's going to happen isn't that Ether is going to rally to a new all-time high, or that, insert altcoin here is going to just rally to the heavens. What's most likely going to happen is there's going to be a recovery. They're going to track side by side, and we're going to see Bitcoin break a new all-time high, while all the other altcoins get left in the dust, and we see Bitcoin dominance start to bottom.
I like that.
So let's go back and take a look at what happened during this liquidation event. Is that a chart error? Why is it? It must have gone down. It must have stopped charting that day or something. But you see this, obviously a very significant decline. But during the recovery, it slowly surged up. It formed this bottom, right? And then again, what ends up happening? Bitcoin climbs, and the dominance slowly makes a recovery. And then again, we see this rotation from Bitcoin back into alts. Okay. All of these buckets of assets, from USD to Bitcoin to alts to riskier alts, are all based on they're based on a few things. So one, how risky are they? How liquid are they? Okay. Can I enter and exit the market without just losing my ass on the trade? Second thing is, how much free floating capital is there? It's really these two things, and these all outline the risk profiles associated with them. With the risk comes confidence in the market. So if Bitcoin's showing it's macro healthy, and Ether and larger altcoins are showing that they're macro healthy, that's when these shit coins and just like insert scam coin here start to flourish. These are all based on confidence and risk factor. These do not run unless these are looking strong, and they happen in a sequential order, and they work their way backwards, because that's the only way to enter and exit the market.
So what Schmitty is going over right here, this is Bitcoin Schmitcoin. That's who you hear talking. Obviously, if you see me just sitting here and a voice talking, it's not me. What he's going over is the fact that, yes, there was Wyckoff distribution, Wyckoffian distribution. It was identified. We kept our eye on it for a while. Here on this stream, this is something we've talked about forever. Schmitty, he's been talking about it a lot on Twitter and a couple other places. So anybody who's interested in Wyckoff, we've had our eye on this. And not to say we're all experts or whatever, but it's one of these where if you're into Wyckoff at all, you say, whoa, okay, let's like consider that this is serious. So bringing this home, when you see a Wyckoff distribution pattern of some sort, there's actually a calculated level that like a target level. So I have had the discussion where, hey, what if we go on to a bear market and it lasts 4 years or 2 years or whatever until we finally come back to a bull market? And in fact, there is a way to calculate using this distribution top where the target is actually like 9 to 10K. Like it's way down there. But an equally possible level is a much higher target. It calculates to between 31,000 and 26,000, according to Bruce Frazier, and I'm sure he's right. But that calculated target was provided before the wick down to 30. And then here yeah, right. And so as time has gone on, we've seen how price action it hit 30, it bounced around, it hit 31 or 32 or whatever it was, and it's kind of memed sideways. So despite the fact that there are lower targets, that does not mean it has to go that low. So as good traders, as people trying to be one with the market and not push our bias onto the market, we must understand that there are the market will give us signs and help us lead toward what the actual future outcome will be. It doesn't matter that, you know, maybe I sold it like above 50,000 and I'd love to see $9,000 or $10,000 Bitcoin, right? Because hey, I could buy, you know, 4 or 5 times what I sold for. Doesn't matter. Doesn't matter. The market doesn't care what we want. So we have to be good observers, good students of what's going on. So anyway, welcome if you're just tuning in. Schmitty, back to you.
Similar to trading ranges, how you can calculate a target, you can also do that with things like blow off tops. This would be the blow off top where the market descends following this massive increase in value. And it just becomes unsustainable. The typical drawdown for a parabolic blow off is about 85%, you know, depending on the market and depending on liquidity and all that other kind of stuff. But it's about 85%. So a lot of these, a lot of the people on Twitter, when you see them talking about, you know, the targets where it's like, oh man, we're talking about 9K. They're doing that because they're equating past market tops, which have all been parabolic blow-offs. You know, if we look at history, they've all been parabolic blow-offs. They're just making the assumption if this is the top, then there should be an 85% correction following that, which is the perfect scenario to have people become overly bearish on every bounce. And those are the market conditions we want to see. We want to see people being overly bearish, because what happens to them is they all get short in here. They all have their stops here, and they just get their asses handed to them on the breakout. And it happens over and over again until we actually get the blow off top. So, you know, long story short, it's just really important to not be married to what you think, just like what Jack was saying, what you think or what you want the market to do. You have to adjust your bias every day, right? And that's why it's really important to have objective tools. It's something that I always tell people that I'm teaching how to read the market is you need to have 2 things. And these are both objective sources, not something that you can look at it and be like, this looks bullish. It's something that's like, no, per these parameters, this is defined as bullish. And you have 2 models. One is a structure model, and one is a trend model. And until the trend model gets violated, the bias is default bullish. I'll throw this at you. The macro make or break line that I use personally is really simple. It's the weekly 50 EMA. You can see the market has only ever touched this thing a couple of times, and every time it's either been bought up or it's led into a bear market, right? And something really important to note is what's happening right now. If we start trending below this trend, that is the definition per my personal trend model as bearish. Anything trending above this is a bullish market condition. And if you've been around for any length of time in crypto, you know that getting overly short or overly bearish too early is like the most depressing thing ever, because you just keep trying to short the market. You watch all your friends get girlfriends and you're just sitting there crying, and it's just you know, it's a miserable and I'm saying that from experience, man. Like I remember back in 2017 getting overly bearish right here and and just thinking, like, there's this tendency that people have where it's like, oh, this is gone. You know, you hear people say this. They say something like this: this market is overextended. It's up 200% in 2 weeks. Like, and they just have this objective, this totally non-objective rationale. They're like, oh, it's gone up a lot, therefore it must come down. It's like, no, it really doesn't have to do that at all. Like I can tell you that just based on my own experience, I remember thinking this. I remember talking to other people and hearing other people say this shit, and it's just like, you just get left in the dust if you don't have objective things to gauge the market with. It doesn't care what you think. The market works the way it does because it tricks you into thinking it is doing one thing and is going to do the total opposite. And it's exactly why we're seeing the market just floating up right now. on these lower time frames because everyone keeps shorting it. We know everyone keeps shorting it because the funding on all of the derivative exchanges are all negative, meaning you're getting paid to take out a loan to long the market in the correct direction, right? People keep shorting, and it's as long as people keep shorting this shit, it's just going to keep breaking a new high. It's going to trickle down into like this little low. It's just going to keep going. It's going to keep going until eventually we see something like this. Boom, boom. So we see something like this. Or something like this. Like this price action should look really familiar right now because that's exactly what we're doing here. We even have the same little Adam and Eve double bottom. You know what's really funny about this too is it's the same fucking news as in 2017.
With the
it's
China bans Bitcoin.
China bans Bitcoin. You know what caused this drop right here? China banned Bitcoin. China.
Yeah.
Bitcoin banned. That's what all of this was. All of these drops. China bans Bitcoin. China bans Bitcoin. They unban it, we rally. They unban it, we rally. It's like the same thing over and over again. It's actually incredible.
One question from the chat earlier. There actually several people asked this. What is your trend line there? Is it EMA or MA or what is it? The blue and red moving trend.
I trade on multiple time frames, but I keep my. It's if I'm looking at the 15-minute, the 4-hour, the daily, it all scales, and these are just the 50 EMA and the 200 EMA. On lower time frames, I do use something a little different. I use the 600 EMA as well, but it's the same sort of thing. So, for example, if we're looking at the low time frame right now, fun fact: if you want a good and simple low time frame strategy and bias, these golden crosses, which just means that the 50 EMA crosses the 200 EMA. These are really, really great bellwethers for bullish and bearish behavior. Like here's a really good example here. When we had the death cross here, meaning the 50 crossed below the 200, it crossed and it just stayed bearish the entire way down. And we're seeing quite the opposite here, right? We see the bullish cross, and we see the market just dry humping this 50 EMA all the way down, or all the way up rather. But yeah, it all scales. It's just the 50 EMA and the 200 EMA.
Okay, so here's a question for you, Schmitty. And I know a lot of people have asked me this personally, and I'm sure you get this question a lot too. So it's something that has to be thought. So if someone had been sidelined for the majority of this downtrend, or they had cash they're looking to deploy, when you see a violent move down this hard, is a reasonable expectation for this to take days to recover, weeks to recover, V recovery? You better all in right now, you're going to miss the whole ride?
I don't view the market through the lens of time. I view it through the lens of price action. Everything that I personally view the market through is through the lens of market psychology. And if I had a ton of money, where would I need the market to go so that I could comfortably enter or exit the market? Right now, we're seeing a very logical zone of buying, which is right here, right? Like all in here. If you follow me on Twitter, I mentioned the idea of clearing this low.
I was going to ask you about that too. Yeah.
Yeah. And that has to do with liquidity. If you were long at any point since this year, okay, so I guess this is the annual open right here. Bang. If you got long at any point this year, your stops are most likely below this line. So if you have a ton of money that is sidelined, like say you're a Goldman Sachs type fella, and if you enter the market, you will just eat so much slippage, it won't be profitable or worth your time. You have to push the market to what these are called liquidity pools. And it's literally just a zone where everyone else will have their stops. All of retail will have their stops in here. And if you push it past that, well, what happens when you breach the price? It triggers if you're long, right? Say you're betting the market's going to go up. It triggers a market sell, which is perfect if you are a large fella because that's going to give you the liquidity for the buy. That's why I was thinking down here. Now, what we're seeing is the opposite. We saw a retest and it didn't even have the chance to go down there. So for me, if I was sidelined, I would feel comfortable looking at the daily chart, and I'm assuming most people here are not looking at these like micro time frames and stuff. I would feel comfortable deploying capital if I was late, anywhere around like right now. We saw a really, really, really nice daily close a couple of days ago. Right here. We saw this really nice bullish engulfing candle. It's above a logical level, which is this support, turned support, turned resistance, turned support. And right now we're seeing the retest and rally off of that support. So right now is a great time to start thinking about deploying capital. The added risk is, well, what's your upside, right? If the market rallies from here, it's most likely not going to just turn around in here. It's going to run into a logical point, whether it's here or here. Say hypothetically we do go into a bear market. Well, most likely what's going to happen is we're going to run here, reverse, and make new lows. So you don't really have this like cushioning and time on your side. Whereas if you bought here or here, you have all this extra buffer and price action to kind of just figure it out. But it stands to reason, based on the last two daily closes, sorry, we're most likely going to head up and retest at minimum this 45K. It would probably be prudent to start layering in and dollar cost averaging on the way up. But, you know, like this is like, if you're thinking about it like you're a drowning man, right? This is the water level. And everything below here is like, oh shit territory. And everything above here is like, oh my God, I can finally breathe. Here comes the Coast Guard and they're going to pull me out of the water. This level right here is based on the weekly level. This price right here outlined by 38.1K. Everything above that is like, that's perfect. We saw a really perfect retest of not only our macro trend, our weekly trend, but weekly support getting retested and accepted. And now even on the daily trend, that same level is being flipped into support. So these are all the things we want to see for bottoming behavior. Even if you are bearish, you should be considering this as a possibility, because you know you can't be like the market doesn't just go down in a straight line and bounces and bounces and bounces. So at minimum, we should be expecting a bounce to 45.5 at minimum. That would be like the minimum upside target from here.
But I'm with you all day on that, the wick into the liquidity pool below. And I just, number one, I keep hearing buy the dip, buy the dip, buy the dip. And I think sentiment wise, I still feel like there needs to be that last final flush that like, oh no, it really is a bear market. Like I kind of want to hear that kind of stuff a little bit more sentiment wise before I feel good. Number two, this was like the second largest drop in Bitcoin's history, like ever, that, you know, that cascade from 40 to 44 to 30 or whatever it was, that little moment in time. Maybe I could be totally off, but I feel like it's going to take some time to recover from that. Like, I've heard of some really big, like I say big for me, but probably a small whale size that are just like, I'm out. Like they survived the dip and they're fine and they're basically back at break even, but they're done. Like their confidence is shaken. Their whatever bots they had running, you know, that entire liquidity is screwed up. If they had some kind of, if they had a bot running on an exchange for like margin, any kind of margin involved, even like a 2x, they're done. They're liquidated. That was it. So I have heard that there's some sizable folks that they've lost a lot of confidence in the market. So I think there's going to be more to it than just, okay, we've shaken out the weak hands. Let's go to the moon. I think we need to see some macro signs, like a macro accumulation of some sort, something to give confidence, get back above, you know, some key moving averages, a few retests, etc. That's my thoughts. Obviously the market doesn't care really what I think. It would just like, for me personally, to give me a lot of confidence to just slam the all in button. That's the kind of stuff I would need to see. To bring it home, the last thing I was gonna say is, just like you were talking about, like folks drowning, that's a lot of overhead resistance right now. People who are just like, oh man, just get me back to break even. Get me to 41 and I'm out. Give me 42 and I'm out. Like, I can still hear those folks in my head because we gap down so hard and fast that I feel like there's a lot of overhead resistance, but we'll find out. Maybe we just cut right through it.
Yeah, so if you want some like super bull porn arguments, the main argument would be, because this was such a strong move, they won't get a chance to get out because they're fucking liquidated.
Okay.
They're already out.
Fair.
They're already out. Something like this comes to mind, on the COVID drop, where, you know, people would be expecting like, oh, there's gonna be strong overhead resistance, and it's just like, nah, like the resistance, if the drop is profound enough, the resistance gets evaporated. Like we saw that on here.
Yeah. But right? You see, like even that's like 3 or 4 months of just sideways. You know what I mean? Like whatever it was, after the 6K breakdown. That's like, that would give me confidence. Just something to where it's not just like, okay, 2 days, we're good, send it.
Yeah, I mean the grand, you know, the big grand sign of like really like, this is like sell your remaining kidney kind of shit, would be if we get back in the trade range.
Yeah, I'm with you. I'm like marginal.
Yeah. If you are a skeptical bull, or maybe your confidence is shaken, or maybe even if you're a bear, the safest thing to do is to play it level by level. So outline, you know, your support and resistance on whatever time frame you're looking at, whether it's daily, whatever, and play it level by level. If you're just getting in here, obviously you probably don't want to go full clip, because if we go here in reverse, well, then you're going to be kind of shit out of luck. You don't really have the luxury of this extra space down here. But, you know, if you go here and you take profit, you're like, okay, cool. And it keeps going up. You're like, okay, I'll just buy back in higher. No big deal. No harm, no foul, right? So the best piece of advice I can give is like, take it increment at a time. Like, here's one increment, right? Here's another increment. Here's another increment. You know, we can think of these as like individual little checkpoints where the market will go through and it's like, okay, are we doing this? We're like, oh, everyone's looking around. They're like, well, are we doing this, guys? And if it gets the secret password, they go to level 2 and they're like, okay, you know, like, okay, do I get in here? And they're like, okay, cool. All right. And then once we get here, and then everyone gets girlfriends on top of that, you know? So like, don't think it's a lot of people make the mistake of thinking that the market is like this all in all the time kind of thing. The biggest mistake I made early on, and mistakes I see people still making, is just do what makes you comfortable. You know, like, fuck what everyone's doing on crypto Twitter. Fuck what I'm doing. Fuck what you're doing. Just do what makes you comfortable. Do what makes you sleep at night. Don't be constantly checking your phone all the time. And it's like, because at the end of the day, regret is way worse than regret of making the wrong trade and losing money is way worse than being like, oh man, I wish I was in that move. You know, like, the market is, it's not going to go straight up without you. It's not going to go straight down without you. Like, take a day. Because I know a ton of people that got liquidated. It was one of the most brutal liquidation events that I've ever seen.
Yeah.
Probably on par with the COVID drop. You know, so
Josh Olszewicz is Carpe Noctem on Twitter, guys, but he's real famous for saying price is not going to go into infinity without you. It's just not.
Yeah, exactly.
So yeah, and just like what Schmitty is saying is there is no trend right now. Now we're speculating on like, okay, what's going to happen next, because you know, we like the whole PvP aspect of whales versus retail and that kind of stuff. So we like to discuss like, what is the market theory? Like, what is a way that whales could come in and absolutely obliterate retail? Or which way is retail leaning so that when the rugs are pulled, then they fall. So is retail really bullish? Is retail still in buy the dip mode? Have they been liquidated out? Like, are they done? So these are all things we enjoy talking about. But make no mistake, there is no, like, right now we are consolidating. It is not a full-on trending market. And as a quick recap for anybody late viewing, we have hit a very key Wyckoff distribution price target. There is a point on the chart that has been identified as where the price was projected to go. It was between like 31 and 26, and it hit 30 and then 31. So maybe that's it. So to answer the question of the live stream title, does Wyckoff say we've bottomed? It very likely does, and because price doesn't really care what we think, there are secondary targets much lower. But given the macro environment, given the fact, like Schmitty said, that we did not have a blow off top this time around, it was like a stealth top is kind of what I called it before. It was a distribution top. Whales did dump on retail or fool them or trick them or whatever. But the question is this all? Is the dip over? Or is it really going to be like a multi-month, even potentially multi-year bear market down to like 10K? So both are potential, but they are equal. They are equally possible. It's not like, well, the 10K target is actually 99% and this one's only 1%. No, they're equal. So it is up to us to be unbiased traders and monitor what's going on and watch for price consolidation and then break of key levels. Are we going to go up or down from here? We'll watch.
Yeah, and I will say 2 points, one on the micro and one on the macro. So the immediate downtrend that we've made has been broken. So like if you just draw like a really basic diagonal from the top of the trading range to, just draw a straight line, we have broken that really cleanly and on really good volume as well. This is much stronger on some alts like Ether. But one thing that has me leaning more toward bullish continuation is that, going back to what I was saying earlier about it's a constant liquidity problem, right? And the best way to get out on, this is why we see this on every shitcoin ever. We see an exit pump, right? We see this quote unquote like exit pump. It's because it's one of the few ways to get large liquidity to exit the market and dump on retail. Well, the same thing works in Bitcoin. Same thing works in every market. It works in Tesla. It works on every scale. The best way to get out of the market if you're a smart, patient investor is on these parabolic blow-offs. And with something like crypto and, Bitcoin, but crypto in general, it's nothing but hype events. And so seeing a distribution top like this, that just leaves so much more on the table. The same macroeconomic environments that brought us into this bull market are still here. Inflation's going crazy. We're having there's gonna be a round of foreclosures that are about to start taking place. I have a really hard time seeing a world where the crypto market macro tops without the parabolic blow off, because it's so easy to do. It happens all the time. And if you can do it, why wouldn't you? There's no question about it. During this distribution range, when we had just all of these blatant scam coins just being printed, like we had the Shiba Inu, like people were cloning Doge, for Christ's sake. I mean, like, if that's not a local top signal, I don't know what is. But that doesn't mean it's an absolute top. It just means that there's a lot of brush that needs to be burned through. Like, this was the equivalent of a wildfire that took place. We cleared it out and we go, okay, how's everyone doing? Okay, we got rid of the really risky investors. We got rid of the high leverage traders, and now there's another cycle gets born. So, look, here's the yearly open. We retested it. Yeah, so it was like, oh, cool. You got into crypto, huh? Well, enjoy this. It's like everyone that started trading crypto this year just like had their asses handed. I mean, dude, I can't tell you how many people have been panic texting me and stuff. or messaging me and they're like, what do I do? I'm like, I don't know what to tell you. I mean, welcome to crypto.
I think I tweeted this out. This is like, it's got to be weeks ago now, but there was an excerpt from the book. I believe it. I'm probably going to butcher this, but I think it was called The Death of Currency, something like that. But it's about the German mark back in like the 20s, back when it went through hyperinflation. And a guy, he wrote out, like very objectively, he wrote what was happening at the time. And one of the things that was happening was, and he words it in a really interesting way. If anybody has the link to this, let me know, because I'll like read it out loud here. But it was something to the effect of everyone, and he basically described retail, but he was like, everyone from the individuals who cleaned the horses, the stable boys, to the guys who ran the shoe shiners, were talking about the latest stock. And they would work together and it would go up like many multiples. And then over here, like, it was a really interesting thing. The death of money. That's what somebody in chat said. Yeah, that's what it is. But it was like, it was a scary comparison to what we're seeing today.
So what was the correlation between that and the stock market?
So the correlation was because as your currency dies, whether you realize that's what's happening or not, you flee your currency. You sell your currency for literally anything else. So everything else went up, in comparison. So stocks would pump like 10x, and everybody was talking about it, and they'd have a great time with it. So it had nothing to do with like earnings to value. There wasn't like some concrete method. Things became very detached and very pumpy. And then, somebody pointed this out during the whole GameStop thing. And then Bitcoin, and then now, AMC's the latest meme, and Doge and whatever. But you start seeing these really crazy disconnects that literally haven't happened in decades. And it's either everyth's fine and, hey, nothing to see here, as the building's burning behind you, or this is bad, and you got to understand what it is. So only hard assets survive, said chat. Gold, land, commodities. And yeah, I think that's kind of the way it's heading.
But back when we were at 10K in Bitcoin, I became really bullish because of what I started seeing with the dollar. And I started to notice that the dollar, of course, just like any other cycle in our economy, like the dollar goes through waves of inflation. And I started to notice there were really strong correlations between very key moments, not a direct correlation, not a one-to-one correlation, but very key moments in the stock market and with crypto, that when the dollar was showing macro strength, Bitcoin would pull back, and when it was showing macro weakness, the trend would be, okay, Bitcoin goes into a strong bull market. And I was like, of course. That's because if you're a big investment bank, or a hedge fund or whatever, you're going to having in an environment where you have a weakening dollar, the real risk is having the dollar.
Yeah. You lose if you have the dollar.
Yes. And vice versa in a strengthening dollar environment. And right now we're in a very massive weakening event for the dollar, like a very, very, very massive one. And I think that's exactly on par with what you were saying about, the Weimar sort of situation. Obviously we're not here where we're like putting wheelbarrows of money out for a fucking loaf of bread or anything.
Right.
But we are seeing insane valuations of people that are just willing to just throw their money away because they're like, I don't want to have it. Like, I don't want to have this dollar. Well, and it becomes this like self-fulfilling prophecy at the end of the day, because it's like, there's this positive feedback loop that happens where people are like, okay, the dollar is weakening and other things are going up. I'm going to buy this other thing. Well, the other thing goes up more. And so people are like, oh, my dollar is not doing anything, so I'm going to buy this more. And so at the end of the day, there's going to be this critical tipping point where there isn't enough dollars. There aren't enough dollars to keep the demand up, and it's going to collapse. The question is just who's going to be left footing the bill. What brought us to the dance is still here. The same macro dollar weakness is still present. These are weekly candles, by the way. This is a terrifying trend, but we came up, we had a 7-year trading range here. We came up and then pinged right off of this thing. And there's not a whole lot of sign of it stopping. The last time we did something like that, we had a massive bear market for the dollar, like multiple years from 2002 until it ultimately bottomed in 2008. So 6 years of that.
Did that correlate with the gold run?
Yes. Yeah, it did. Here's gold futures. So 2002, 2008 was here. So that entire dollar bear market was here. Yeah, and then there was another leg up on this. And this is a log chart, by the way. So it's like, so this is what I was talking about, by the way, guys. When I said parabolic blowoffs don't just happen with shit coins and Bitcoin. Like this happened with gold. You know what I mean? So like this is an overall market characteristic that happens across all markets. It's just the result of human psychology. As long as that's the really, really cool thing about learning market psychology and just learning technical analysis in general, is that it applies to anything that a human being is involved in trading, because greed is the same regardless of if you're making Bitcoin, gold, or fucking gold doubloons. You know what I mean? It's like greed is the same. And this is just a chart of greed and fear and changing of hands and capital rotation. It's all the same. They all behave the exact same way.
Somebody in chat said we need a Peter Schiff emote.
Oh, dude, and you just know this dude has been jerking himself dry to this like 4% bounce. Dude, I mean, like, what is this? That's actually probably a little bit more. Yeah, he's just like red in the face. Dude, you know what I mean? Like, holy shit, is that guy too? Do you follow him?
Yeah. Dude. Well, I used to. I don't anymore.
Oh, I love it because every time he tweets about how bearish it is, it fucking bounces. You know, so he's like, he's like, well, you Bitcoin bulls are fucked, and he's just like, well, fuck, Bitcoin outperforms me again week after week. But you know, he had his little day in the sun where he's like, oh, we finally broke this 8-month-long bear market at gold. He's like
4%.
Fuck yeah. I think this is actually, what is this? Yeah, 3%, whatever.
What a guy. After like 3 weeks.
Yeah, he's just like sweating and like panting. He's just like, oh my God, this is my time to shine.
Finally, before I die, I get one more pump.
I will say this last thing. So this is, there are some really, really good macro charts. So if we look at like Ether Bitcoin right now, you see this across a couple of large market cap alts. Some of them actually look really shitty, like Bitcoin Cash, for example, or
how dare you? You mean Bitcoin?
Yeah. I mean the real Bitcoin looks like shit.
Real Bitcoin.
Yeah, like this is like this just you know what I mean? But like if you look at something like Ethereum Bitcoin or stuff like that, there is a potential that people I kind of mentioned this, that like the initial bounce off of a continuation bottom, alts thrive first, but then they lack on the follow through. And we saw this here and here, here and here, where they kind of just like made this like lower high kind of thing.
Interesting.
But the point I'm making is that in a bear market, we don't see these bounces. We don't see these levels get respected. We see them get blown through. So, I mean, yeah, in my opinion, this looks like the beginning of something, not the end of something. You know, if we were looking at something like this, for example, where it was just like this insane markup, and then a blow off top, I'd be more inclined to humor these macro bearish arguments. But like, this is a lot of capital that just hasn't had the chance to leave the market yet. You know what I mean? Like, this was a trading range that was from 2018 to 2021, 3 years. This has to get sold somewhere, and that doesn't happen in liquidation events. That happens in parabolic blow off. So just, you know, if you guys are perma bears out there, just keep that in mind, that they're, you know, these like quote unquote dinosaur coins or whatever, like the new meme of the day is. At the end of the day, they are the beginning and the end of these macro markets. So that's where you should really be keeping your eye for like a pulse on the market or these like macro charts here. And until they get broken, you know, the trend is your friend. So
just noise. Yeah. All right.
Yeah.
I guess the only real, like, if I had to succinctly give us a summary, yes, we had a Wyckovian distribution top. There was a target level for that top. That target, there's actually like a couple of targets, but one of them has been hit square in the face. So that could have been it. And that was what the first part of the stream really was. So if you want to go back and rewatch the VOD, watch from about 20 minutes in to maybe an hour or so. But that's where Schmitty made really good comments about what's going on. There is a potential secondary target much lower. But given, like we were discussing, given a lot of the macroeconomic events, to me, it's less possible, even though it's like, as far as Wyckoff's concerned, I think it's like an equally possible target. But the market has to want to go there, and there'll be signs of that. There'll be broken levels and broken levels and broken levels. So we'll, you know, with some observation, we'll be able to tell what the future holds. Last thing, Schmitty, I'm going to put this on you because I thought this was really good. Somebody in chat said they wanted to hear your best case for bear, unbiased case for bear, just as a yin to the yang of being bullish right now.
Like what would I want to see if,
or based on what you have seen, like what are some check marks in the bear? Like, hey, we're actually going to 10K, you know, like something like that. Like what are some signs potentially of bear?
Sure. So what I would say is, so I wouldn't make the argument now. More so, I'll make the argument that if the current market structure fails, that's the lens that I would like to make the argument. So, because right now, like this is a very promising market condition, but if the market rallies, and it forms what's called a bull trap, and what that means is quite literally it traps bulls. So it baits people into thinking, oh, you know, this is the recovery rally, blah, blah, blah. That will have specific characteristics. These are the signs that you should really watch out for if the rally looks like shit. Okay, these are objective signs that we can look out for. What these three things mean, I'll give you an example with our last trading range because it'll probably be easier to visualize it. So what made me really confident that this was a distribution trading range is all based on price action, based on the candles, and based on the volume that accompanied it. Following we would call this breach of the trading range being this gray area. We would call this a sign of weakness, sometimes labeled as like SOW. But what that means is this is a moment where we say, that's not good. We saw a really high spread on the candles. It breached the low of the trading range. And this is not a moment to get super bearish just yet, but it is a moment where we say, okay, there's something going on here that we need to keep an eye out for. And there's a potential that we are in this moment right now. What's going to give us the clues of or forecast bearishness would be one, compressing volume on the rally. So when we see a rally like this, for example, where we see a rally where we see, you know, quite clearly we see a swing high, swing low, like definition of a local uptrend, right? When we see compressing volume where the volume tapers off, this is a sign of potential weakness in the market. It's not necessarily a sign of absolute weakness, but it is a sign that if things do get shaky, they're likely to accelerate quite quickly. And that's exactly what we see off this high here. So off of the high, we see a very low volume breach into a new all-time high. It kind of stumbles back into the trading range, and this massive ejection to the downside, where we see very high spread. And a spread literally just means like wick to wick of the candle. So we see here wick to wick, this being the spread. We see very high spread on very, very high volume. And that is a sign that there's a lot of floating supply in the market. That coupled with the what we would call a feeble rally, meaning really tight compressed bars, really decreasing volume, that's not the sign of like really strong bullish interest. So if we see a rally like this, it could start off strong, like say for example we were here where it started off strong, it looked great, right? Volume could have been better, but overall the candle spread was pretty good. As it matured and it progressed, you could see it didn't really pan out a whole, very well. And as it finally reached the top, it petered out in volume. The candle spread was like very, very narrow. It puked a new high, and that would have been the sign that there's going to be a continuation, but then it rejected it. And the reaction, that's what gives us the confidence in these sorts of setups. So if we see this rally come up, even if this does rally and we see a strong, convincing rally, the way it arrives at its local top is going to be very telling. So keep an eye out for compressing volume, where the volume tapers off, compressing spread on the candles. Like, so we see, for example, here, it starts off with a wide spread and it narrows at the highs. That's a telltale sign that there is an imbalance, that there's an overflow of supply and not enough demand to soak it up, and an expansion off the highs. So, and it happens in this order too. So that you see the compressing volume typically front run the compressing spread. The compressing spread front runs the expansion off the high. So the expansion off the high is literally the opposite of the characteristic that brought us into the rally. So we see decreasing volume, decreasing spread. Well, we see the opposite happen, where we see expanding volume and expanding spread off the highs. So if we start to see stuff like this, that is going to be really concerning. But the opposite is also true. So if we see the rally come into these highs and it's on good volume, the spread's not noticeably tightening, that is also a sign of likely macro bullish continuation. So it's really hard to tell right now what it's going to do, but when it arrives at these local levels, these are the signs we have to really keep an eye out for, because the way the market traps bulls is it starts off strong and it peters out at the top and it just loads up all these longs up here because it faked the market out with this strong move. It faked the market out with a strong move, and then bam, it just pukes out the low, and they never have a chance to get out. So, it's a quote unquote bull trap. They're trapped. They never get out. And that's how they get liquidated, because they never have a chance to get out and profit. They sit there and they wait. They think, oh, the market's going up. Surely I'll get a chance to get out. They'll probably stack more margin on top. And it has this compounding return where people will double down on their underwater longs. Like maybe they longed here, they double down, it pukes a new low, and they get liquidated until it finally hits its ultimate bottom. So
yeah. And with that, and I think you'll see this in the charts too, but like, just like that last kind of going into the early part of May, there was a pretty nice little rising wedge. There'll be some TA patterns occasionally where you could say, oh, look, that's, MAs and EMAs be damned. Like the actual candles themselves are forming of a pattern that is looking like a bull trap of some sort. So
yeah. And to be honest with you, like this, in hindsight, this is very obvious. Like if you look at really basic, like momentum oscillators, pick your momentum oscillator and insert it here. These are all diverging into the all-time high, and it should have been, it's hard to tell in the euphoric moment, but like these decreasing highs, if you're looking at the SMI or you're looking at the MACD, these were all diverging on all momentum, by all standards of momentum. Like these sorts of things were showing red flags, and people were just willing to look the other way because it's really hard to
diamond hands
to feel that in the moment. Yeah, exactly. Like everyone's getting girlfriends and you're still sitting there crying, so if you follow me on Twitter, you might have seen me talk about this, but I'm going to start doing a sort of like lecture series where it'll be like 2 to 3 hours, with question and answers periodically, because I'd like to talk a lot. But the idea is basically that, like, if at any point you felt that some of the stuff I was talking about or the material I was covering was a little bit over your head, the idea would be that you'd be able to understand the stuff that I'm talking about, like basic supply and demand, basic understanding of how to read trading ranges, basic understanding of why markets move, what are the forces behind making markets move, and like what are logical destinations for markets to move to, because a lot of times it's like kind of counterintuitive. I mean, case in point was right here with Bitcoin, right? Like everyone thought, oh, this is the bottom, then it just nuked through it. Wyckoff theory would have told you. I don't know if I'm allowed to even call it Wyckoff theories. I don't want to get fucking sued by them or something. I'll say supply and demand theory would supply and demand theory would suggest that there's actually a deeper level to obtain. So if that's something that you're interested in doing, I'm still writing the curriculum for it, but stay tuned for that, because I'll be releasing openings to do that. So
cool. And I'll be blasting that out. So speaking of blasting, be sure to follow Schmitty. I have his @ kind of typed out below the chart there. Mods have been pinging it every now and then. Yeah, ! Schmitty. You'll get his Twitter account. Be sure to follow him. All right, Schmitty. Well, yeah. Anything? Do you want to give more info on your lecture series, or just say follow you on Twitter, or what do you want to?
No, I'll post more about it, because I don't even know when I'm going to do it, but just keep an eye out if you're interested in doing that.
All right, sounds good, man.
All right, thanks for having me, dude.
You bet. I'll have you on anytime. You know that. See you, buddy.
All right. Bye, sweet pea.
I'm just some jackass. I am a nobody. Just doing my best.